All right, folks, welcome to the Real Talk about Millennial Homeownership. We have several attendees I see still logging in. So we're just going to put ourselves on mute, give everyone another minute or two, and then we'll get started. So just bear with us. We'll let our colleagues still log in and we'll get started soon. Okay, well, thank you for joining us this evening for the Real Talk about Millennial Homeownership. My name is Daniel Jacobs. I'll be moderating our event this evening. We're in for a great time here with some great experts from TruLoan Mortgage and from the Stacy Sauls Group of Keller Williams. So I want to go ahead and introduce our panel really quickly. And we have got from the Stacy Sauls Group of Keller Williams, Maria Mull and Allie Hunt. We're very excited to have them joining us this evening. Maria and Allie, feel free to unmute yourselves. So we will be getting to the panel in a couple of minutes. I am the managing director here at TruLoan Mortgage. And with us, we also have my colleagues, Brenda Jarvis and Matt Wise, to be available to answer your questions about mortgage lending with housing. After this event is over, you're going to get an email. So watch your email for the for the download link. It's going to include two really important documents. One is the Smart Guide to Home Buying. This is going to walk you through step by step what to expect through the home buying process. It's going to cover some of the things that we're talking about this evening. It'll probably cover some things we don't get into this evening. It goes into a lot of detail about what to expect every step of the way. It also has in there a really great guide just to help you kind of start clarifying what you're looking for in a home. So the second book that has the picture there of Legion Brewing on it is really has just a lot of articles from other third parties about the home buying process, particularly relevant to millennials with things like student loan debt, and all kinds of things that are really interesting. So someone said they can't hear me very well, and someone else said they can. Okay, so we will continue, and hopefully the person who is having that trouble can log back in and hear a little bit better. So I'm sorry about that.
Can everyone else hear us? Okay. If you cannot hear us, let us know.
Mm-hmm. Thank you.
Great time to use the chat figure.
Exactly. So you know, the other thing is usually we do these pre-COVID at a fun brewery, and we get together and we've got some drinks and some appetizers, and we really get to have that great one-on-one interaction. We really enjoy doing that. Of course, during these times, we're doing these virtually. We're all Zooming, but I do want to talk about a couple things that are different, okay? With this Zoom, we are not using Zoom meetings. We are using Zoom webinars. There's a couple of different features about that than you might be used to. First of all, you probably noticed that if I turn off my screen share for the slide, you'll see there's just the presenters on here, and we're not seeing all of you, okay? So there will be tons of you on there that you see in meetings. So that's one difference. The other is there's a chat feature that many of us are used to using. And you're welcome to use them. We're going to encourage that. And in addition to that, there's a Q&A feature. You can ask questions as we're going along using both the chat feature and the Q&A feature. The advantage to using the Q&A feature is it's easy for us to go back and match up and mark off when we've answered a question. But you know what? If you don't see it and you're comfortable using chat, use chat. We're going to be checking both. In a minute, we're going to practice just interacting using that chat feature as well, because that's the most popular one that people like to use. I just want to pop back over to this screen share, and then we'll get started with our panel. So, a couple things. Just in case anyone has to log off early tonight, I don't want you to miss something that we did promise in the invitation, which is some pre-approval incentives. We're going to be talking a lot about getting pre-approved throughout the evening, but if you decide, hey, I do want to learn more about this home ownership journey that I'm on that's very specific to my situation, even though I'm looking to get, maybe buy not now, but later, we still encourage that. We'll talk about that. Anyone who decides to get a pre-approval, we're going to give you a $50 gift card. We would have spent money with Legion Brewing had we been there in person. We still want to support our locally owned businesses, and we still want you to go out and have fun when you feel comfortable going. So we'll give you a $50 gift card. In addition, if you schedule a time to be pre-approved by Monday, then we'll also give you a free $500 towards an appraisal whenever you do buy a home. Now, just want to be super clear what I mean by that. That doesn't mean you have to rush and get pre-approved by Monday. On the link that you're going to get with those downloads, there's a little button where you can just go onto the calendar, choose a time, whether it's next week or 2 weeks or 3 weeks from now, it doesn't matter. All that is just fine. And once you log in and even you schedule that, that's all we're asking is that you schedule it in the next few days. And then in a few weeks, we'll have your, whether it's Monday or 2 weeks from now, it doesn't matter. But then you're locked in for that credit for whenever you buy a house, whether it's next month or next year, it's fine. So now, I want everyone to find that little feature that I talked about, that chat feature, okay? If you, everyone's computers are a little different and how Zoom puts it on there, but I want you to look and you'll see a little feature that says chat. I want you to click on that, and I'm gonna ask just a couple quick questions. And I just want you to go in and type A, B, C, or D based on which one you think the correct answer is. So the average down payment among first-time home buyers is what percentage of the purchase price? A, 10%, B, 6%, C, 20%, or D, 3%. Okay, I'm watching these answers coming over. Yep. Wow, is all over the place, which is not uncommon. All right, you guys ready for the real answer? The actual answer is 6%. We find there's a big misconception that you have to have 20% down, but you don't. And in fact, 80% of first-time home buyers put less than 20% down. So first myth has been busted. The next question that I have is, if you were buying a $275,000 home, which is the average purchase price over in 2019, in this general area here, average home price $275,000. You waited 1 year from now to buy it instead of buying it now, and you put 3% down payment on it. How much wealth building would you lose out on? In other words, based on historical averages, this house, if you buy it now versus waiting a year from now, it's going to go up a certain amount of value. And if you own it during that year, you're going to pay the mortgage down, the balance, a certain amount. So if you waited to buy it a year from now versus now, the difference in your wealth that you missed out on building is A, $7,250, B, $31,490, C, $16,291, or D, $3,900. What do we think? What do we think? Oh, wow. Okay. All right. We've got some MIT grads here, because on the first one, it was all over the place. On this one, it is a lot of C's. And I see someone says it depends on the market conditions. And it is true. And this is just based on the last 5 years home appreciation levels in this market. So certainly it's not a precise number, but it is based on the precise average for the last 5 years, and that would be 16,291. And look, we can just extend that out and say, what if it was 3 years? If you said, hey, I'm going to wait 3 years to buy, the difference there is 50,000, you know, almost 51,000. And this really speaks to why over time, not instantly, but over time, Americans who own their homes versus rent their homes long-term build about 44 times the net worth and the wealth of renters. So it is really, it's a powerful wealth building tool, homeownership. And that's part of what we're going to talk about tonight, talk about the ups and downs, the pluses and the minuses, and answer all your questions. I want to turn to the panel, but I've got one last question. The typical cost of using an exclusive buyer's agent versus the listing agent when you're buying a home. In other words, you have someone just representing you to go buy the house versus calling the person whose name is on the sign that is selling the house. That's the listing agent. What do we think? It's 3%, 1.5%, 0, or 6? And yep, I see good answers all over. Okay, well,
Is it fair for Stacy Sauls to answer?
What's that?
Is it fair for Stacy Sauls to answer? That's cheating.
I've seen that. So I won't answer this. I'm gonna let Maria and Allie, our extraordinary real estate professionals here on the call, answer that. And I'm gonna stop sharing this so we can see everyone's faces. Welcome, Maria or Allie. Why don't you take that one? What's the right answer?
Thank you. We're excited. We're excited to be on here.
Yeah, so it's a common misconception. I saw that there were a lot of answers across the board, but it actually costs the buyer in most situations 0%. It really doesn't cost you anything to use us, as we typically get paid out of the transaction.
So let me ask you about that though. So
Yeah.
you say you get paid out of the transaction. So then wouldn't it make sense that I should call, if I'm a home buyer, the listing agent, because then there's less money that the buyer's paying in this transaction, I can get a discount?
Nope. So the seller has already agreed at the beginning of their listing. They've already agreed at what commission they're going to pay out. Be that, 6%, 5%, whatever they've decided they're going to pay, that's going to be split between either the listing agent and the buyer agent, or the listing agent all on their own if you call the listing agent. So you're either giving the listing agent 6% and they're going to represent the seller, or you can work with us and the seller's going to pay me or Maria and it doesn't cost you anything.
And we represent the buyers.
Got it. Okay, so in other words, the seller has decided this is the commission level, whether the listing agent handles all of it or one side and then you do the other side, they don't get a discount on that commission rate. So now, all right, so that's great. So I'm not going to get a discount, but still, like, the listing agent probably knows a lot about the house. So why wouldn't I want them, who probably intimately know that property better than you, to help me with buying the house? What am I going to get more working with you than I am them?
So this is where hiring the right buyer's agent for you is always in your best interest. You always, people don't realize you can actually interview a buyer's agent. Just because a buyer's agent comes to you and says, hey, I can represent you, let's sign this deal and we can work this together. Well, they may not be working in your best interest. So they can always interview a buyer's agent. And that's what you want to do. You want to ask those questions. What can you do for me? How are you going to represent me? How are you going to look out for me? And that's what our team does. We are there from A to Z, all the way from start to finish. We are with you, telling you exactly what's going to happen, A, B, C, D. You will always know. You will never be left in the dark if you're working with our team. I don't want to speak for all those agents out there, but I know for the Stacy Sauls team, that's what we do.
And but from a legal perspective, who is the who are you representing and who is the listing agent representing? And if I were to use the same person for both sides, does that change who they're representing?
It does. So that was my next point. So when you call the listing agent and you decide, hey, I might get a discount here, or the listing agent might know more, what you'd actually be entering into if you were to work with that listing agent is called dual agency. And in that type of agency relationship, the agent can't really represent the best interests of either the buyer or the seller because they really have no loyalty to either. When you've got an exclusive buyer agent, they are there to specifically represent your best interests, help you determine the best price to offer, help you determine, what repairs to negotiate, all of those great things that come along throughout the transaction. That listing agent is not going to be able to get as detailed with you when they're in that dual agency. So you really do want that exclusive buyer representation.
Right, got it. Okay, I'm gonna look really quickly before I ask another question. And I just wanna see if we've gotten any questions from our audience. Ultimately, everyone, this event, we will drive questions, but I want to hear your questions because we want to make sure that they are being answered. So just as a review, I know some people have logged in since we got started at the beginning. And there are two ways to ask questions. You can go into the chat feature, but also there's what's called a Q&A feature. And you can just go right in there and type your question in. You can do it with your name, you can do it anonymously. Either way, we just want to make sure that we are answering your specific questions. So please go ahead and start entering those questions in. But meanwhile, I would actually like to turn to Matt and Brenda and let one of them answer this. Talk to us about, we talked earlier about this whole thing with the pre-approval, okay? Walk me through, and our participants here, walk us through what it means to be pre-approved and like what to expect through that process and why you would go through that.
Okay, so let's first differentiate between two important definitions. There's a pre-qualification and there's a pre-approval. A pre-qualification is when you submit an application to the lender, and they, based on the information that you're saying on the application, are pre-qualifying you, saying they're basically trusting you and they can approve you for a loan if everything that you say on that application is true. That will not get you far in this market. The Charlotte market is a very competitive market. You need to be pre-approved, and the definition of being pre-approved means that we as the mortgage lender have reviewed the very important documentation that backs up what you're saying on your application. We have reviewed your income and asset situation. We have reviewed your credit report, your DTI, and a bunch of other things that we try to take a look at as we are not only customizing the loan and finding the loan that's best for you, but we're also making sure that you qualify for whatever we're setting you out there in the world to work with Maria and Allie to go and find that property. Before we can set you out into that world, we need to know what we can and can't do, and the pre-approval is a very important part of that. In fact, you can't do anything without that, because let's say that you fall in love with a house and you want to make an offer on it today. Well, if we don't have you pre-approved, then there's nothing you can do about that, because they're not even going to submit an offer, or even, in some situations, I have agents that say, hey, I've got this great person. They want to look at properties today. Can you please pre-approve them, because I don't even look at properties unless we're pre-approved. So it's so huge that we know up front, and we've done our work, up front to eliminate any questions about what you can and can't do. For us, that process is also, a little bit more involved than most, in the sense that we work with a lot of first-time home buyers. So we're going to talk a lot about budgeting. We're going to talk a lot about the monthly budget, what makes up your payment. We're going to make sure that you understand all those different components. We're going to talk about the different loan programs and why we think, this particular loan is the best fit for you and what your goals are. And then we're going to talk a lot about closing costs and then the process, so that, Maria and Allie are trying to educate you on the buying process from that, realtor perspective. And we're trying to educate you from the lending perspective, but the goal is the same. We want to orchestrate all the things that go on behind the scenes so that you can do your job and we can do ours, and we make the process smooth for you. But one of the things that makes the process smooth is that you not only know what's going on, you know, right now in the process, but you know what the next steps, you know, and if we're looking around that next corner, what that is going to be. So that all starts with that pre-approvals process, where we establish what our budget is and we establish what we can and can't do. It's huge.
Good news is folks are starting to get more comfortable with the questions. We're going to go to a couple of them in a minute. But I actually, Matt, you mentioned in the Charlotte market, you know, it's really important because it's competitive. Actually, I would just like to address perhaps one of the elephants in the rooms with Maria and Allie. You know, COVID-19 has just obviously changed everything about the world, right? Talk to us about how that impacts the real estate buying process from really two perspectives, I guess. There's one, which is the safety perspective, right? About going out and looking at houses. And then secondly, what impact has it had on the market? I know to begin with, we thought there were going to be a lot of bargains out there. Maybe that hasn't really panned out. So just walk us through really the specific impact that you see COVID-19 having on the process of buying a home.
Sure. So you kind of hit the nail on the head. Towards the beginning of this year, when this all started happening, we did have a lot of buyers who kind of thought that they were going to start getting deals because, you know, who were going to lose their jobs, you know, the economy was in a downturn, all of these things. And I had these buyers coming out and saying, oh, well, you know, we're looking for a great deal and this is the time to do it. And really that's just not the case. In the Charlotte market right now, our inventory is so historically low. I believe we're at almost 50%. I read it in the Charlotte Agenda the other day. I think 50% inventory of what we were at last time this year, or last year this time, we were at 50% less inventory than we had. So that means we've got less houses to show you. Therefore, there's more competition. So we're not seeing, you know, we're not seeing buyers getting deals right now. We're actually seeing buyers having to go in and be really, really, really strong with their offers. Going in, we're seeing sellers get over 100% of list price, if not more, with very little concessions. Really, the deal that you're getting right now, and Stacy just said it, the deal that you're getting right now in this market is your interest rate. And that's really what COVID has done for buyers is, I mean, your money is almost free at this point. So it's crazy not to, right? But at the same time, you know, as far as safety precautions go, we have been, you know, we wear masks through our showings. We're very respectful of all the sellers that are opening up their homes to our buyers, making sure that we as the agents are the only ones touching the doorknobs, turning on the lights, things like that, so that we can minimize any contact in the homes, so that these sellers can feel comfortable having the buyers come through.
So, you know, it's somehow I think we've got the reverb now.
Oh, sorry.
That's okay. I don't want to hear myself 7 times. I'm not sure if anyone even wants to hear me once, much less 7. No, I appreciate that. So the reality is people are out there shopping. They are buying. In fact, they're buying, you know, in significant numbers compared to the inventory available. And when we were talking about inventory, what we were saying is, you know, how many houses are available to buy, and just like any inventory in the store. So I'm not sure if this is still accurate. I know about a month ago, I read that in this market, the inventory was like just under 2 months. Now, what I mean by that is, it means if not another house came up for sale based on the demand, we would run out of houses for sale in 2 months. Right. And a normal balanced market is 6 months inventory.
Correct.
So it just goes to show you.
Well, that's a good reason to get pre-approved, because you want the seller to take the buyer seriously. So you don't want to submit an offer without that pre-approval, because that seller is not going to take you seriously and they're going to go on to the next offer.
Well, you make a good point. And so Corey asked, what are some ways to get my offer how to make it my offer stronger? Whether it's due diligence money or more earnest money, what's the difference? Which is a great segue to talk about that process. Shows they're making a cash offer, or gets a big discount, or why do we care if you're paying cash or getting a loan? He just wants to know sort of what makes it stronger and how do we address that? So can you just walk us through that from a buyer's agent? And I'm sure you do listings as well. So from both sides, how do you see an offer being the strongest?
So this is where your agent is going to be very important. This is why it's very important to pick the right agent, because I know all of our agents on the Stacy Saul's team, we know how to make those strong offers. We know how to get those offers, to win. And so we will pull comps in the area. We will see what the house should be priced at, or if it's overpriced. We will guide you, like in North Carolina, for due diligence. People who are not familiar with due diligence in North Carolina, that's a certain period of time, whether it's a week, 2 weeks, or 3 weeks. You have time to do all your inspections and the appraisal. So we will guide you on the appropriate amount, whatever you're comfortable with, to put down for due diligence. You'll do your inspections, and if something comes back on the report that, for repairs, we help negotiate that with you and walk you through that. And so, we've always said, we're there every step of the way. We know earnest money. We know kind of what a seller is looking for earnest money and due diligence. And so we're just there to help guide you on the amount that you're comfortable with putting down on a house for, $300,000 versus $400,000.
And to add to Maria's point, and to answer that question again, what do we recommend as far as, the strongest offers, and are cash buyers getting discounts? No, cash buyers are not getting discounts. They're coming in thinking they can get a discount, but sellers are seeing how much, how little inventory is out there, and sellers are seeing that their neighbors are getting, 5, 10. I'll be honest with you guys, I lost an offer $25,000 over asking in a multiple offer situation. We still lost that offer, and we went $25,000 over. So it's like Maria said, it's us coaching you on what the best offer is, as far as price point, due diligence, earnest money, even cutting back on your due diligence period, making, aligning yourself with a mortgage partner like TruLoan Mortgage, who are closing loans in 30 days or less, so that we know that we can present the seller with a quick close if that's what they're looking for. But yes, those are all things that we would coach you on to get you into the house.
So the little chart that I have up here, the navigation plan here for going through the lending process, we've used some terminology here that touched on some of these points through the buying process. And this will be included with the link that everyone gets at the end of our event with the download. And it just kind of walks you through step by step. And then the other document has a page for each one of these steps. It really just explains that. And we'll continue to go through some of those points throughout the duration of our time this evening. I would like to.
Hold on 1 second, Dan.
Yes.
I just want to ask Maria and Allie if one of them could just hone in on what's the difference between due diligence. I don't want to spend a lot of time, but what's the difference between due diligence money down and earnest money down that the borrower has to write when they sign that contract?
Excellent.
Sure. So it's due diligence money and earnest money are two very different things. And due diligence money, the way that I describe it is it's basically saying to the seller, hey, Mr. Seller, I really like your house. I want to do my due diligence on it. I want to be able to do my inspections. I want to make sure that my loan can get approved. I want to get my appraisal done. And for those efforts, and for you removing your home from the market during this 3-week period, I'm going to give you $1,000 in due diligence funds. That due diligence money goes directly to the seller at the beginning of the transaction. And if you walk away for any reason during that due diligence period, the seller does get to keep that. What the due diligence money does, it protects your earnest money. What your earnest money does is it opens up your escrow with the closing attorney. And that's just really kind of a good faith deposit. We've got some money on the table, and your due diligence is going to serve to protect that earnest money should anything come up during that due diligence period. And again, the earnest money and due diligence are usually, earnest money is usually a little bit less than due diligence. I typically do about $1,000 for earnest money, and depending on the price point, $1,000 to $2,000, maybe $2,500 for due diligence, unless we're going into the higher price points. But that way, if you do surrender that due diligence money, you're still getting that $1,000 back in earnest money.
And Brenda, when we're looking at a sales contract that has been written and there's due diligence and earnest money, correct me if I'm wrong, but all that money is counted toward the down payment as a lender, and we're considering putting 3% down, 5% down, 7%, whatever they're putting down. Is that right?
Yes.
Correct.
Okay, great. So I see that someone said, look, I got pre-approved earlier this year and did not end up purchasing the house that I was interested in. Do I need to get pre-approved again? And how long does that last for? So Brenda, maybe you can take that one for us.
The pre-approval lasts, well, the pre-approval lasts as long as the things that we approved you for are still in place. If that makes sense. In other words, as long as you still have your job and you still make the amount of money that we approved you for, then that is still there. As long as you still have all the money that you said you had, then your pre-approval is still in place. The only thing that we'd have to just update those things when you finally found your home. We just have to have updated pay stubs and updated bank statements. The only thing we would have to repull would be credit, but we do not have to do that for at least 90 days for one agency and 120 days for another agency. So let's just say 3 months. So at least your credit is good, and we will not have to pull that again for at least 90 days. So you're good for 90 days on that piece.
So if it's been 6 months, I'll give TruLoan Mortgage here a plug, and they got it somewhere else. They probably should talk to you, Brenda, or Matt, to get that refreshed. But if they did have one and they wanted to continue using the lender that did it before, they probably could too.
Yes.
Okay. So let me see. We have another question that was really about the best way to approach closing costs as a buyer. So I think of closing costs as being sort of part of the overall investment that you're putting into the house with down payment and closing costs. So Matt, would you like to kind of approach that?
Sure. So closing costs exist anytime you're buying a house, anytime you're buying a property, there's going to be closing costs. You have to, in essence, pay for an army of services and goods from a number of people, you know, it's going to cost money. One of the things that we do when we're sitting down with anybody in the pre-approval process is we go over those costs in detail. Just to give you, you know, a broad overview, you've got lender's fees, which is, you know, across the board, usually going to be a flat fee. It's not going to be dependent anymore. It used to be that lenders charged maybe 1% origination, and now that's not the case. It's just usually a flat fee. You've got a set of fees that the attorney that, you know, for all the work that they're going to be doing on their side. You've got to pay for the appraisal, which roughly runs about $500. There's all these lists of costs, and one of the things that we try to make all of our borrowers aware of is what those are. And so you'll know, based on the property that you're buying, our job is to do a really good job of estimating those costs, and we do it, you know, down to the dollar. The interesting thing about closing costs is you can negotiate for the seller to pay those closing costs, either all of them, some of them, part of them, you know, anywhere in that spectrum. Normally, we do a good job of communicating with our agents what the need is. So if we pre-approve somebody and say, let's just use a hypothetical. We pre-approve somebody with an FHA loan that they're doing a $200,000 purchase. But I turn to Maria and Allie and I say, but we've got to negotiate in closing costs of $4,500, you know, to cover some prepaids and whatever the situation may be, then it's important that they know that up front, because the communication between the lender and your realtor and this team that you have is what really makes this work. Because for a lot of people, that is something that's the only way that they're going to be able to afford the house that they want to get, is if they have some closing cost credit coming from the seller. So the way to approach closing costs is to know that they're going to exist, but you have to have a plan that's specific for you and how you're going to deal with it. Now, let me give you another. The person who's putting a large down payment, has plenty of liquid reserves, plenty of savings, and they want the best deal on the house. They're going to pay for the closing costs, and they're going to budget for that. And we're going to do the great job of estimating what those closing costs is on their particular transaction and what they've got to do. So really, it's more about the team and having the communication across the team and having the plan that's set up from the beginning for each specific buyer.
And I think that, you know, one of the common themes with a lot of things is that there are a lot of general answers, but unfortunately there's no easy one specific answer that fits everybody, because everybody's scenario is different. You know, you may have 10% to put down, and you might consult with Maria and Allie, and they say, on this deal, it's going into multiples, like Allie said earlier, that one that, you know, they offered over. So let's have you just pay your closing costs and not ask for that, going back to the question about the stronger offer earlier. So it just really depends on the situation. Brenda, you know, one of the first questions we got, I want to go back to because we didn't get to it yet, and that had to do with putting less than 20% down. They said, if I put less than 20% down, do I need to get some type of insurance, or am I paying additional fees? But before you answer it, I have to let everyone know that we do have two sponsors helping make tonight's event possible. And that is the Costner Law Firm, and Josh Lepak is on the line with us as well. If we have any questions, if we need to ask him, he's readily available. And he is one of the attorneys there at the Costner Law Firm. They do a terrific job. They help you at that closing, go through all the documentation, make sure you understand everything, make sure everything's recorded correctly, etc. The other sponsor that we have is Arch Mortgage Insurance. Gina Baxley is on the line, and we appreciate both of them being a part of this, and frankly being a part of the homeownership process, because they both play such a vital role in it. Brenda, talk to us about this. If I put less than 20% down, do I need to get some type of insurance? Am I paying additional fees, etc.?
The answer to that is yes. There are, if depending on the type of loan, you have government loans, and there's a VA loan, a USDA loan, which is kind of a rural loan, and an FHA loan. The USDA loan and the VA loan require no down payment, so there would be no need for any mortgage insurance. The FHA loan requires at least 3.5% down, and because you are not putting 20% down, you do have to buy mortgage insurance, but you're paying the government for that mortgage insurance, not an outside party. If you get a conventional loan and you put less than 20% down, then yes, you will be required to pay for mortgage insurance. And what that mortgage insurance does is basically it allows you to put less than 20% down. So the mortgage insurance company is going to insure you insure us on behalf of you, that should you default on that loan, then they will cover the difference between what you put down and where that lender would have been had you put down 20%. So the good news is mortgage insurance has changed a little bit in the last couple of years. It used to be, if you put 5% down, this is how much your mortgage insurance was going to be. If you put 10, it would be this. If you put 15%, it would be this. And it went down based on how much you put down. Now it's called, it kind of goes by the risk. So if you are a high credit score buyer with a very low debt to income ratio and typically more than one lender on the loan, you're going to get the best possible. Pardon me?
Well, more than one borrower.
More than one borrower on the loan, then you're going to get the best possible mortgage insurance factor, and it's going to be very, very inexpensive. In fact, you can get mortgage, you can put less than 20%, you can put 5 or 10% down, and your mortgage insurance could possibly be no more than $20 or $30 a month. So in my opinion, $20 or $30 a month to pay to hold on to your money for a rainy day is a good bargain. You can also, there's also other ways to get it. You can pay for it all at one lump sum and not have a monthly mortgage insurance payment. There's all different ways to do mortgage insurance, but the not short anymore answer is yes, there is a fee for it.
And just to be clear, the question was, do I need to go out and get this? And the reality is the borrower doesn't have to do it. We handle all that. It's just part of the loan process. It's just completely handled, correct?
And,
Yes.
and can I just say to everybody on the event, do not worry about mortgage insurance. It shouldn't be what, it gets in your head to prevent you from buying a house, because nobody has been in our office as long as we can remember, and mortgage insurance has been the problem that keeps them from buying the house. It's actually what allows you to buy the house in many cases. And like Brenda said, it's never been cheaper than it is right now. And given when we lay out the options for most people, they're choosing, wait a minute, so I can finance all this money at such a low interest rate, and my mortgage insurance is so affordable, I'll just hold on to my money then. So, I mean, even people that have the money are choosing to not put that. So I would not let anybody be concerned about mortgage insurance. Come talk to us about it, and you'll see for yourself.
And I kind of think of mortgage insurance like those Buick commercials, like mortgage insurance now, it's not your father's Buick or Oldsmobile. It's the Oldsmobile commercial. It's not your father's Oldsmobile, but I mean, it's so much, it's just a whole different deal. It's nothing to be worried about. I would like now to ask.
I'm actually going to address a question because I think I can combine two.
Yeah.
So somebody asked, should I get pre-approved by multiple lenders to compare shop rates? And somebody else asked, would our credit be pulled to obtain a pre-approval? So I'm going to start with the second question first. Yes, we cannot issue an approval unless we look at your credit. First, your credit score is a big part of whether you're going to be qualified, and then, quite frankly, what your interest rate may or may not be. And then it also gives us all of your debts to allow us to take the second piece and compare your debts to your income and make sure you fit in that little box as well. But the second piece about that is, should I get pre-approved by multiple lenders to compare and shop rates? And listen, it is up to you, but I do want to kind of dispel or explain the whole credit pull, in my opinion, myth. And that is that if a bunch of people pull my credit, will it affect it? And it's not supposed to, as long as it's in the same industry, if you will. In other words, if you're shopping for a mortgage and you go and shop with 2 or 3 mortgage people within a fairly compact amount of time, the credit bureaus are supposed to know that you're actually shopping for a mortgage, and they're not supposed to hit you against your credit for that. Same for a car. It's different for credit cards, but for those 2 industries, it's the same. So I'm not going to discourage you from going out and shopping. It really depends on the kind of person that you are. If you're somebody who feels most comfortable when they've compared their options, then quite frankly, that's what you need to do, because we want you to feel comfortable in the end. We hope that in the end that you are comfortable with us, but if that is important to you, then yes, you should go and do it.
Thank you for addressing that one as well. Okay, great. We have Maria and Ali back. I was just gonna do another mortgage question because we had a little technical glitch, but talk to us a little bit about if someone thinks they're not interested in buying now, but they are on tonight because they're thinking about when your lease is up in 6 or 9 months, and they, talk to us about the process of when they should engage and what that looks like, and then what happens if they find the perfect house in 2 months and your lease isn't up for 8 months. So walk us through that.
Yeah. So honestly, whether you're looking to buy next week or you're looking to buy next year, talking with both a realtor and a mortgage professional right out of the gate is going to be so crucial, because one of the worst things we could probably the worst thing we could possibly do as real estate agents is to show you a house that ultimately you can't afford. So what we don't want you doing is being out there looking at houses, searching on Zillow or whatever app that you're using to search for houses, and not knowing what you can actually afford and falling in love with a certain price point that is just maybe not attainable for you, or might be too low and you really could be affording much more, or a different area, or you really could be targeting something that you really want that you're going to miss out on because you don't have that financial piece. You want to have that financial piece in place so that you have that game plan ready to go of, okay, this is what I can afford, this is what I can look for, and be ready whenever that time comes. We do see a lot of buyers that are, oh, I'm not ready to buy for a year. My lease is, I'm in a lease until next year. Well, we've had, myself, I know Maria has, we've had buyers who have broken their leases because it's just a better time to buy than to continue paying their rent, continue paying somebody else's mortgage.
No, but now when you say break the lease, I think of ruining my credit. So when you say break the lease, what do you mean by that?
Yeah, so there's actually, now it completely depends on your property management company. If you're in an apartment, or you're renting from a property management company, or even if you're renting from a private landlord, they're going to have something in the lease about, terminating your lease early, what that's going to look like. There's usually going to be a charge that you can try to negotiate with them prior to signing a lease, or when you are at that point that you are going to be terminating the lease. There's usually going to be a fee there, but that's not going to hurt your credit. If you just, you go about it in the right steps.
When you say break the lease, it's exercising a clause in it that allows you to come in early. It doesn't mean obfuscating your responsibilities. There's a proper process that doesn't hurt anybody's credit or anything.
There's a grace period too. So if you make an offer on a house, you close on it, there's a grace period that you have. You don't, the next few weeks, you're not having to pay that mortgage right away, right? There's a little bit of leadway there. There's a grace period from when you close until your first payment is due on your mortgage. And also, people don't realize that they can ask their apartment complex. If it's a really hot apartment complex and people are on a waiting list, they may let you out of your lease early. It doesn't hurt to ask them if they can get out of their lease early, if somebody is waiting for your specific apartment. So
well, a lot of times they have raised
that rent.
You signed your lease and they would love to get someone in to start paying that new higher rent that they can't charge you because you're in a lease. We've seen that all the time. I just want to point out, and Stacy made a comment, said renting is paying someone else's mortgage. And I say this all the time. Every month when you make your housing payments, you are building wealth every single month. The question is, whose wealth are you building? As a renter, you are always building your landlord's wealth. When you are a homeowner, you're building your own wealth. And that's really just something to consider. And that's one of the reasons toward the beginning, we pointed out that homeowners end up building 44 times the wealth of renters over time. And it's kind of like your 401k, the earlier you start, the more it builds, So I appreciate that comment here.
Speaking of that note, Daniel, going from building your landlord's wealth to yourself, and a lot of people who've never owned a house and they go out and they look for a house and they're like, okay, I've got to find this perfect house. And they just keep, nope, that won't work. And then they finally found it and find what they think is, and then they miss out on it and it's disappointment. The point I want to make here is this is not going to be, if you've never owned a house, this is likely not going to be your forever house. And you can buy a house now that meets your needs and then look again in 2 years, and then you can rent this one out and be that landlord and continue to build your wealth.
Right. That's a great point.
Times again.
Every day. We see it every day.
So I just want to kind of throw that out there as well.
No, it's a great point. Hey, Matt, will you answer this question? As a married couple, if one of us makes more money and also happens to have a higher credit score, can or should only one person's financial information be used for the application and the pre-approval? Talk to us about that. And have you ever,
Yeah, well, listen.
has it ever happened? Have you ever actually seen this phenomenon?
Yes, we see it all the
Every day.
time. When a couple comes in, and by the way, one of the questions we get asked all the time is, do we have to be married to apply for a loan and purchase a house? And I answer that question the same all the time. It's becoming more and more common. I have more, in fact, it's rarer now that I have married couples to apply for that first time home. Usually they're putting off the wedding, especially during the COVID crisis. They're putting off the wedding to one day in the future, and they're buying the house now. So absolutely, two people buying a house, come on down and see us, because that's what we love. We structure the application in the way that benefits you the most. And that's the simple answer. It depends on the situation, where we might have someone with a low credit score that's going to impact our pricing. It could be that somebody has a debt load that's going to lower what we can qualify you for. We're going to take a look at that from all the different angles that we can look, so that we optimize what you want to do and we optimize the loan for you. So in a lot of cases, it might be as simple as having one person on the loan, because we get better pricing and you get a lower interest rate because it's based on credit score largely. And sometimes it's out of necessity. But the answer to your question is yes. We sit down and we work through it a bunch of different angles to make sure that what you're getting in terms of that loan is optimized for you and your needs.
And you mentioned the score, and the question is up there anyway, so I'll throw it out there now. What's a good score?
Listen, credit score, there's a wide range of credit scores. It depends on what your situation is. I don't want to say a general, rule of thumb, because, it's not fair. Some of our borrowers have what, would be considered a low score, but it's a great score for them, and it gets them the house of their dreams, and we find the program that works for them. And so it's irrelevant. Your score is your score. We'll sit down with you and tell you the strengths of the application and what we can and can't do. And yeah, even if we're limited by in terms of pricing or program for the score, it's just like a down payment. For some people, a down payment, the money that they've scrounged together for a down payment is the world to them, and it's what allows them to get into the house. And so we don't like to make generalizations about the score range and all that, because everybody's situation is different. We need to analyze their situation, on its own.
I appreciate that's a great point. Maria,
we do have minimum score requirements. I just want to say that. However, like Matt said, oftentimes if someone doesn't meet it, we kind of work with them to help them get there. Our objective is to try to do whatever we can to help you get into a home. And I've found that if we have people who are willing to work with us, we almost always get there. Sometimes not
Almost
immediately,
always, yes.
but we almost always get there.
Yeah.
So, Maria and Allie, we talked about earlier the importance of having a buyer's agent. I'm not calling that name on the for sale sign, but what if someone wants new construction?
Oh, please.
They go in,
Yes.
just use,
Please call an
they
agent.
still work with you, and they
Please.
just go to the model home.
It is so important, especially in new construction. I mean, in any transaction, but especially in new construction. When you walk into that model home and you see that, bright, shiny, smiling face behind the desk, they seem super nice and they're so excited that you're there and you're going to buy a house with them. But they represent the builder. Their job is to represent the builder. And again, they're going to pay that. The cost of a buyer agent is already built into the price there. You're not negotiating 3% off the deal because you don't have a buyer agent. It's still going to be there built into their price, and it costs you nothing when you're working with a buyer agent who's exclusively representing you. Please, 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 and especially don't go to the models without your realtor.
Yeah.
Because what they'll do is they will try, and this isn't every single builder. We have
wonderful relationships with many, many, many builders in the area, but some of them will, that they'll try to capture your information and keep you on the line and constantly just reaching out to you and trying to get you back in there. And you don't really have a middleman to go in between you and that rep, because ultimately, and at the end of the day, their job is to sell their inventory and is to represent the builder. So please, 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 if you're thinking about new construction, you gotta have a buyer agent.
You know, it's a great, we actually had a conversation a few months ago with one of the top builder representatives in the area. She just won an award for being one of the top ones in the Carolinas. She said, I don't even like it when they don't have their own realtor, a client, because I want someone to explain to them. Now, they're not all, every builder rep doesn't think that way. She's like, look, we already budgeted it in. Like, I want them to have that person because I want them to feel comfortable, and, you know, because I want them to buy their next house from me in the new phase in 3 years when they want to move up. And so I want them to be happy. But not everyone thinks that way. And one of the tips that she gave was interesting. She said, you know, if a client comes in, they should at least say, even if they're just walking around or driving around on a Saturday, oh, I'm working with Maria Muller, I'm working with Allie Hunt, I'm just looking right now. Would you recommend that as well? Is that a good approach?
Absolutely.
Yes, absolutely.
That way it's kind of registered that you've got representation. And
right. What I typically do with my clients who I know are interested in new construction in the area, I'll actually, when we first meet, I'll give them a stack of my business cards so that when they do go to these new construction communities, they can give them my business card and say, hey, this is who I'm working with, so that builder rep knows they've got a realtor.
I thought you just did that to give out to all their friends and family and everyone, you know, at work, but it's also to give to the builder reps.
Yeah.
What a good idea. Okay, Brenda, let me ask you, we've got a self-employed borrower or attendee here. They want to know how many years of tax returns are needed if I'm self-employed. What's the answer on that?
The answer is 2. We need at least 2 years of tax returns in order for you to qualify as a self-employed borrower. Now, I have on occasion been able to get folks done when I have 1 full year of tax returns, and then I can work off a P&L for that second year. But I guess we absolutely have to have 1 year. And then sometimes I can work with just being in that second year.
Right. So in other words, generally speaking, if I'm not mistaken, it's either 1 or 2 years, depending on how long they've been self-employed and other factors.
And something to add here on this topic. A lot of times the quandary for self-employed people is they're trying to minimize their tax basis with their write-offs. And, you know, so it's better to come and visit us early so that we can help you sort of take a look at your current situation, what your, you know, what your taxes are actually showing, what you qualify for now, and come up with that long-term plan, because you may want to, you know, you want to make sure that you are, you know, optimizing for what you want in the future. And if what you want is to qualify for a loan, then you need to know that, you know, up front and plan for that. So you can't come and see us too early, especially if you're self-employed.
That's a great point. The CPA is not the only one for tax planning if you're a prospective home buyer, right? So that's a really good point. Now, what about if someone with COVID got furloughed earlier this year and they've gone back to work, or they're still furloughed? How does that impact in the qualifying process for a mortgage right now, Matt?
Listen, the mortgage industry has tried to adapt as quick as possible to the COVID crisis. And one of the things that, you know, that we've done to adapt is if it makes sense and someone was out of work and now they're back to work and we can show that they're back to earning their income, then we can approve you for a mortgage. It's as simple as that. So, you know, there's a lot of people that have been experiencing this, and this is what the guidelines are set up for. You're showing that you have this ability to repay and you got that income back. As long as you're back into receiving that income, that's what we need to show. And once we can show that, you're back in that situation where you can be pre-approved for a mortgage again.
And I just want to make a point about that is you don't have to be in the same job. I mean, if you lost your job and it went away and that job isn't there, but you find another one, then that's fine. As long as the income makes sense for what you want to buy. So you don't have to wait on that particular job coming back.
Oh, and there's one more thing that Brenda really caused me to realize. We get a lot of questions about, well, I don't have a 2-year history with this company. A lot of people believe a lot of myths about the 2-year history rule. Look, when we get your mortgage application, we need to show a 2-year history of your employment. But we've done loans for young people right out of college. You get an accounting degree, you get a job as an accountant, you get that first paycheck and that offer letter, come see us. We can get you a house that next month. So do not,
is the work history, right?
Yeah, 100%. Do not, let us sit down and look at your work history and we'll tell you what we can and can't do. Don't necessarily believe everything you hear out there.
So Maria and Allie, I would like you to address homeowners associations, okay? So when I think of a homeowners association, I think of a condominium or a townhouse, but also what we call PUDs, planned unit developments. Can you just address what all that means and what people get for that?
Well, I mean, it just depends on what neighborhood you're purchasing in. I mean, homeowners means different things for different subdivisions. It can include landscaping, upkeeping, the lighting in the neighborhood, pool upkeeping, things like that. So that's what your HOA dues are going towards. Now, you also have CC&Rs, which are covenants, conditions, and restrictions. And that's something completely different. And that's what is allowed, what you're able to do at your home. If you're, certain fences you're able to put around, the house. If you can put an RV, park an RV in your, on your property, things like that. So that's something completely different. I know a lot of people get those two confused, but your HOA dues are usually for landscaping, upkeeping around your house.
Okay.
Yeah. To add to Maria's point, an HOA basically serves to make sure that CC&Rs, if there are CC&Rs, they are being upheld, and to maintain any community amenities. But there is a big difference between HOAs in townhome condominium communities and single-family home communities. Sure. So they're typically going to be a lot less in a single-family home community, because in townhome communities, the HOA is not only going to cover the amenities, like Maria was saying, yard maintenance, pools, sidewalks, lighting, all of that stuff. They're also going to hold a master title insurance policy over the exteriors of the townhomes. So the exterior sides and the roofs, they're going to cover under their insurance policy. So that's why you're going to see higher HOA dues on townhomes and condominiums, because they're holding that insurance policy as well.
Because when you're buying a condominium, you're buying the inside of that structure,
Exactly.
Not the overall common structure, right? Whereas you're buying a single family property, you're buying the dirt and the exterior structure, the interior structure, all of it. So you have to respond. So you don't pay anyone for the maintenance on that, because that's your responsibility.
Right.
If it's a condo, you just have the responsibility for the inside.
Right.
And everyone shares the responsibility for the exterior through that HOA, and that's what the fee covers, right?
Mm-hmm.
Perfect. Okay, great. So we have a question. Also, I'm going to direct this to Maria and Allie. Josh wants to know, is there an online resource to help analyze neighborhood choices? For example, a site that maybe lists the school district and parks and crime rates and property taxes, etc.
Yeah.
Yeah, so yes and no. There's not one general website that has all of this information, except Google. Go to Google and you'll find anything. But no, there's not one just general website for any area. Due to fair housing laws, there's a lot of things that we can't discuss, like crime rates and statistics, things like that you're more than welcome to research on your own. However, there are really great resources online for different communities. All of the school district websites will have your zoning information for neighborhoods. And then you can always go to your county websites as well. I use York County Gov all the time. I live in York County, so I use that website all the time. But you can go to your county websites to find information on parks and things to do in your community. So yeah, there are a lot of great resources online. Unfortunately, they're just not all in one place.
Yeah, no, it's interesting. We actually we do different analysis for our clients, and when we put in the address, we have a website that will give some of that data. But to your point, it doesn't give all of it due to some of the laws. You know, we're not allowed to give all of that, but we do have. If anyone has some addresses or some areas you're interested in, some things your realtor is going to be better suited to provide, some things we've got access to, and some you're just going to have to do the research on Google and such. But
greatschools.org is a great resource for schools.
Comes in. I'm sorry, go ahead.
Greatschools.org is a great resource for
What's it
schools.
called?
Greatschools.org, I believe.
Greatschools.org.
And also, a lot of people don't think to call the local police department, and not 911, not for that, but just the local number, and just to ask about the community, or if there have been a lot of calls there for, you know, various reasons. You know, get in touch with the police department, and they'll be able to, you know, share with you different things that have come in, different calls in that, you know, particular subdivision or wherever you're looking.
Okay, I've got a good little tip just like that I'll share too. So I know I've done this before when I was looking to buy a house, or even back when I was renting and we were looking at this apartment or that house or such. You can call the utility, whether it's Duke Energy or Piedmont Natural Gas or whomever controls the utilities for a particular property, and ask them what the average utility bill is on that property for the last year. And typically they'll share that with you. And when you're budgeting, as a mortgage lender, we look at your debts that are on your credit report and the mortgage payment. As a consumer, as a buyer, you got to look at all of that, right? So that's not a bad thing to do either when you're thinking about your budgeting. So Brenda, you know, one of the things that we haven't been asked that we typically are, and I would love for you to address, is the student debt burden that so many of our clients have. And I know a lot of times we'll get into weeds with people asking really very specific questions about that, because we've all heard student loans keep us from qualifying for homes. And some people think they need to wait until they've paid it down to qualify, but oftentimes that's many, many years. Talk to us about student loans and how that impacts qualifying to buy a home. And you are muted, Brenda, if you'll please unmute yourself.
So, for so many different things that we have several different loan programs that come from all different places, and depending on the loan program, depends on how your student loans are viewed as far as debt you're responsible for. Like government loans, FHA takes either 1% of your total debt or whatever your payment is on your credit report, whichever's higher. If you move over to the conventional side, we take either what's reported on your credit report. If you have an income-based payment, for instance, I've met with people who have a couple $100,000 worth of student loans, and their income-based payment is $27 a month. So you're muted, or maybe you're not. So if you look at that from the, if that person was trying to use a government loan, I mean, they would have a, you know, $2,000 payment just for student loans. If you went over, if we're looking at a conventional loan, they would have a $27 payment. So, and then there's all kinds of different things we can do. If they have more than $100,000 worth of debt, we can get it amortized over 30 years and use that payment. During COVID, almost everybody's student debt comes up as zero, because they're all in, you know, you're not paying your student debt right now. So it shows on your credit report as a zero payment for everything. So then we have different rules for that. And in some cases, it's a good thing. Some cases, not so much. So this could be a little window if you have a lot of student debt where it might be to your advantage to look at buying a house right now. And the answer, the easiest answer is let us have a look, because that's the best way to find out.
So without going into loan officer 101 training, because it is super complicated, just know that it really, and I know we keep saying this so often, is it really just depends. And as you can tell, there's like there's a lot of puzzle pieces to that. I don't see a lot of other questions coming in right now, so I want to we're going to begin to wrap up soon, unless we get some more questions in, because we'll stay until 7:30 if you have questions. But I would really just like to ask Maria and Allie, you know, obviously I know that you want everybody that's attending here tonight, if they do take the next step in their home buying journey, to select you and the Stacy Sauls group. But really, you know, just what should people look for when they're looking for a buyer's agent? What should they be asking? What are the tough questions? What are the particular credibility markers that they should be looking for, whether they're interviewing you or your competitors when they're making a selection?
That's a great question. That's typically something that we actually ask our leads that we get in, you know, what are you looking for in a realtor? But above all else, you want to make sure that it's someone that you feel comfortable with, that because both your realtor and your loan officer are going to know, you know, very intimate details about you, and about more so your lender, you know, they're going to know more about you than probably your significant other. But you want somebody that you make sure, you know, you feel comfortable with, but that can walk you through the process step by step. And that can be there to hold your hand through the process step by step. You know, there's just the part of going under contract is very exciting. You know, you go out, you look at homes, you put in an offer, you go under contract, super exciting. And then it's like, okay, well, what do I do now? And there's a lot of stuff after you go under contract before you get to the closing table, your inspections, your appraisal, your repair negotiations, all of this stuff that has to happen that, you know, you may not actually be aware of, and you're not really sure where to turn to. And that's something that our team does. And Maria mentioned it at the very beginning of our call tonight, but we actually handle those things start to finish. So once you go under contract, we have a full-time transaction coordinator. She schedules your inspection. She schedules your closing. She's very, very in line with the lender, you know, getting anything that the lender needs, you know, helping facilitate anything, kind of really just running interference, being the middleman here, to help you get to the closing table. And that's really something that you want. You want somebody who knows the steps, knows the process in and out, so that you feel like you truly have somebody who is advocating on your best, you know, for your best interest, on your best behalf, and really, you know, just.
I think that somebody can tell within a few minutes when they meet an agent if it's really going to work personality-wise, right? When we meet people for different things, you know, if your personality meshes well with the other person or not. So I think within a few minutes they can tell. And the best advice that I can give is you don't have to stay with that realtor. Like, you interview them. If it's not going to work, you go your separate ways. But do it before you sign a contract, because then it just gets complicated. But however, with us, if a person is just, they don't, you know, fit well with us, or they think that, you know, we're not providing the service that they were hoping for, we would rather them go with someone else and be happy than to just be completely miserable and hate us the entire time. So within a few minutes, they'll know if that realtor is the right fit for them or not.
And before I ask the same question, thank you so much for that reply. Before I ask the same question, I'm going to ask Matt to answer that on the lending side. We did have someone talk about that they pulled their credit report as a consumer, and it looks like there's some debt on there that's not theirs, and they may be a identity theft victim. First of all, I'm sorry to hear that. That's terrible, and it's real. It happens. But why don't we just get together with you on a one-on-one basis and look through that, and we'll help you navigate through that. Sometimes it's really easy and simple, and sometimes it's not. But we'd be happy to look at that and try and help you navigate through that. Matt, what do you think? And again, I know you want everyone on this call to get pre-approved and do their loan through TruLoan and mortgage, but ultimately, you know, whether they do or not, what are the questions they should ask? What should they be looking for in a mortgage lender?
Well, listen, there's more to your mortgage lender than the rate that they're offering you. I'll tell you that right now. Everybody has great rates. Rates are phenomenal right now, but the process is what you want to focus on, because you have to have someone who communicates with you and someone that guides you through that process, and that's really what we focus on. Mm-hmm. So it does not matter. Let me give you an example. We recently did a loan for a Wells Fargo executive. And we did that loan even though she works for Wells Fargo, because Wells Fargo could not do that loan in the time frame that she needed to get that loan done. And they were honest and told her that even as an executive. And look, we love Wells. They employ a lot of people, a lot of our friends here in town. But there's some things that the big banks are not good at, and that a small boutique lender like us that has the time to devote to our clients and delivers a higher level of service, that might be valued by someone more than than other aspects. Like, suppose a person is optimizing for rate, they can always sort of find a lower rate from some call center in Las Vegas at 3 o'clock in the morning if they want to. That's a tricky game to play. What we try to do is be as honest with our clients and give them the best advice that we can, and then work with their team, work with their realtor behind the scenes, because it's the process that we're all orchestrating that is so important. And if we can make that less stressful for everybody and make it actually fun, which is actually what it is, and most of the time it ends up being fun. But the other thing, I'll plug us, because look, our customers and clients, that they tell the story, and we have the unbelievable reviews that we get from our clients and our realtor partners, and that really is the proof, and that's really what you want. When you go to a restaurant and you go on Yelp, you look at those ratings, because that tells you about the food and the service, and our reviews tell the story too, and it's hard to compete with us. But then again, that's what we're designed to do. We're a local boutique lender that's designed to make sure that someone who comes to us has an amazing experience that they'll love. That's why it's our tagline.
Yeah, I would say that whether you're looking to buy a $100,000 house or a $1 million house, you deserve the same boutique level of experience. And
yep.
Really proud to be offering that. And I think Matt hit the nail on the head. Check the online reviews. And the same thing that Maria and Ali talked about is just make sure it's a good fit, personality-wise. You're going to spend some time
personality.
You're going to be open with each other about a lot of things. So, it's just going to be a good fit. Let me see. I think we got one more message, and I want to see what it is before we start wrapping up. I'm 23, and I just purchased a home with another realtor who's a family friend. Join this webinar to see. Oh, I like that. I did not. It's
giving us a plug.
I haven't read it. They're saying I just popped on to see if the process is normal, and so far I can tell you that Brenda, Matt, Maria, and Ali know their stuff, and they sound like they really care about you. If you're on the fence about buying, my advice would be go see them. I don't know who wrote this. I promise we did not pay anyone to write that.
Yeah, let's
that very much.
Let's
get
Leonardo's contact information.
Right.
We need to send him a job offer.
Right.
Daniel.
You got a business.
Daniel, there is a question here I want to address real quickly.
Yes, please.
In the Q&A, there's a question about advantages, disadvantages of FHA loan versus conventional. Listen, this is part of what we cover in the pre-approval process, because it can get fairly technical, but I'll give you a couple. For some people, an FHA loan is the perfect loan for them, and it couldn't be any better. For some people, a conventional loan is the perfect loan for them, and it couldn't be any better. But typically, you're going to see the big difference being in the mortgage insurance side. Conventional mortgage insurance is something that can go away at a certain point when you have the equity in the house. And FHA is the life of the loan. So that mortgage insurance is sort of built into that loan for the life of the loan. But there are other things that make FHA unbelievably wonderful. You know, it allows you to get in with a low down payment. People that have had credit issues in the past, it helps them. Conventional loans, you know, they're for people with super high credit scores, you know, above average, and that, you know, usually have a good position to put down. But listen, that's the part of the process that we go through, and you walk you through those options, and even things that are outside FHA and conventional. So I would say, you know, come talk to us.
And Maria and Allie, when's the right time for prospective homebuyers to get their pre-approval?
Now.
Now, before, if you think
They're not going to buy until next year, right?
just whenever, yeah. No, if you think that you want to buy a house, if you think that you're ready to start planning for that next step in your life, that's when you take that step. Because again, having that financial piece in place first and foremost is going to be your biggest tool.
Sure. And Brenda, what does it cost to get pre-approved?
Nothing.
Nothing, just a little bit of time.
A little bit of time.
Maria, Allie, Brenda, Matt, thank you so much. I'm going to go back to sharing my screen and wrap this up. I appreciate you spending your time with all of us this evening. Let me get that back up. There we go. And thank you so much for going through that. And I want to reiterate, Maria and Allie are with the Stacy Sauls group of Keller Williams. We will be sharing their contact information in the email you get after this. Don't forget to look for that. You will have those pre-approval incentives. Get your $50 gift card to Legion Brewing. Support the local businesses that are suffering during this time, and schedule for your pre-approval appointment. It's super easy. It's self-service to select a time that works for you. We make it easy. We have daytime, morning time, evenings, lots of options available. And then if you do that, whether you buy soon or not soon, you'll get a free appraisal credit up to $500. So watch that email for that sign up coming from us. And also you'll have that download, which includes everything from your path to buying a new home to articles and other great resources, all at no charge. And you can also forward that link to friends and family so they can download it as well. Additionally, if you would like us to send you a printed copy, like you would have received if we were sitting at Legion Brewing together right now, you can just respond to that email with the survey, and we will send one to you. The other thing is we will be asking for a survey. We really value your feedback. As Matt said earlier, we really value the feedback, not only with the experience of getting a loan, getting pre-approved, going through the homeownership process, but we want to know how we can improve these events for other future home buyers. So please spend 2 minutes and give us a review so we can learn more about what we're doing really well, where we're adding value, and what we could change to add more value. So thank you again for joining us tonight with the Real Talk about Millennial Homeownership seminar. Thank you again to Costner Law, Arch Mortgage Insurance, the Stacy Sauls Group, and TruLoan Mortgage. Everyone have a wonderful evening. Thank you.
Thank you.
Thank you, guys.
Bye.
Bye now.
Thank you.
Yeah.